picture the moment. You open your banking app on a Tuesday morning. You're already running late. The coffee hasn't hit yet. You check your savings account because you've been meaning to for a few weeks, and you finally remembered. You have $11,000 in there. You've had it in there for almost a year. You didn't touch it. You did the responsible thing. You left it alone and let it grow. You earned $52. $52 on $11,000 in a year when the Federal Reserve rate sat above 5%. You stare at that number for a second. You close the app. You go about your day. Because what are you supposed to do with that information? The account says savings. You assumed it was doing something. You assumed there was some connection between the money sitting in your account and the broader economy's relationship with money. There was a connection, just not the one you assumed. And here is the part that took me a long time to understand. The $52 was not a mistake. It was not a glitch. It was not a product of extraordinary circumstances or a bank failing to update its rates in time. It was the business model. In 2023, the Federal Reserve raised its benchmark interest rate to 5.25%. That rate, called the federal funds rate, is the closest thing the American financial system has to a price tag on money itself. When the Fed funds rate is 5.25%, that is roughly what money costs in the wholesale market, where banks and financial institutions exchange it. J.P. Morgan Chase, the largest bank in the United States, paid depositors 0.01% on its standard savings account during that same period. Not 2%, not 1%, not 0.5%, 0.01. Bank of America, 0.01%. Wells Fargo, 0.01%. Citibank, 0.04%. The Federal Reserve rate, 5.25%. That gap, 5.24 percentage points between what money was worth in the economy and what the largest banks in America chose to pay the people who supplied them with it, did not happen by accident. It was not the result of oversight or administrative delay or competitive pressure the banks hadn't yet responded to. It was the designed outcome of a system that has been deliberately constructed over decades to transfer wealth from depositors to institutions, legally, quietly, at scale. Most personal finance content will tell you to open a high-yield savings account and move on. That advice is correct, but it answers the wrong question. The right question is not what you should do. The right question is how this gap exists at all, who built it, how it works, and why $7.5 trillion in American retail deposits sat in sub-1% accounts, while the risk-free rate was above 5%. That $7.5 trillion, earning just 4% more in interest, would have produced $300 billion in additional income for American depositors in a single year. That $300 billion went somewhere else. This video is about where it went, how the mechanism that redirected it actually functions, and, most importantly, how this system was constructed so deliberately that it required an act of Congress to create and 4 decades of regulatory decisions to maintain. When you deposit money into a savings account, you are not storing it. You are lending it. That distinction is the foundation of everything else in this video, and most people have never been told it directly. When you hand $11,000 to your bank and open a savings account, the bank does not set that money aside in a vault with your name on it. The bank takes your $11,000 and puts it to work immediately. It lends a portion of it to mortgage borrowers at 7%. It lends a portion to small business owners at 9%. It holds a required reserve at the Federal Reserve. It deploys the rest into Treasury securities, overnight lending markets, and a range of financial instruments that generate returns substantially above the rate it promised you. This is called fractional reserve banking, and it is the foundational mechanism of commercial banking in the United States. Banks are legally permitted to lend out a multiple of the deposits they hold, earning market rate returns on money that cost them your deposit rate to acquire. You are the bank's creditor. The bank owes you your money back, plus whatever interest rate your account agreement specifies. That interest rate is set by the bank, unilaterally, at whatever level they choose, within regulatory limits that do not include any requirement to pass through a specific portion of the prevailing Federal Reserve rate. The spread between what the bank earns on the money you lent it and what the bank pays you for lending it is called the net interest margin. It is the most closely watched profitability metric in commercial banking. And in 2023, when the Federal Reserve rate hit 5.25%, the major American retail banks reported net interest income figures that represented the largest spread capture in more than a decade. J.P. Morgan Chase, $89.3 billion in net interest income in 2023. Bank of America, $57.5 billion. Wells Fargo, $52.4 billion. These three institutions alone captured nearly $200 billion in the difference between what they earned on depositor money and what they paid in return. Your $52 was part of that calculation. It was the number the bank decided your share of the arrangement was worth. The rest, the portion reflecting the actual market rate on your money, appeared on a different line of their income statement, under a category you were never shown. Here is where this story gets forensic, because the current structure of the deposit rate market did not emerge naturally. It was built. And understanding when and how it was built is what transforms this from a consumer complaint into a documented institutional design. For most of the 20th century, the rate banks could pay on savings deposits was legally capped by the federal government. The regulation was called Regulation Q, and it was enacted as part of the Banking Act of 1933, the same legislation that created the FDIC. Regulation Q set interest rate ceilings on savings and time deposits. Banks were legally forbidden from paying above those ceilings, regardless of what prevailing market rates were. The official justification was that rate competition between banks during the Great Depression had destabilized the banking system. Capping deposit rates would prevent, in the language of the era, destructive competition. For decades, Regulation Q functioned as a structural suppression of deposit rates, paid for by savers in favor of bank profitability and system stability. By the 1970s, with inflation running above 10%, the ceiling became a crisis. Savings accounts were paying 5% or less by regulatory cap, while inflation eroded purchasing power at twice that rate. Americans were losing money in real terms by holding savings deposits. Billions of dollars began flowing out of bank savings accounts and into newly created money market mutual funds, which were not subject to Regulation Q and could pay market rates. The banking industry and Congress responded with the Depository Institutions Deregulation and Monetary Control Act of 1980. Over 6 years, Regulation Q was phased out entirely and removed by 1986. The argument for deregulation was straightforward. Free market competition would ensure depositors received fair rates. Without regulatory caps, banks would compete vigorously for deposits and pass through prevailing rates to attract them. That argument turned out to be only partially correct. Competition did increase rates, but not as much as the free market theory predicted, and not evenly across depositor types. What the deregulation framework did not account for was deposit stickiness. The behavioral reality that retail depositors, unlike institutional investors, do not move money based solely on rate. They move based on rate, plus the cost of switching, plus inertia, plus the depth of their existing banking relationship. Banks learned this quickly after 1986. The depositors who moved were the ones with the largest balances and the most financial sophistication. The depositors who stayed were the ones with lower balances, deeper product relationships, and less awareness of alternatives. 40 years later, that pattern is still the operating assumption of the traditional retail banking model. Deregulation gave banks freedom to compete on rates. It did not give depositors the information infrastructure, the switching ease, or the rate transparency that would have made that competition function as the theory predicted. The result is the market you see today. The rate gap is not a malfunction of deregulation. It is the predictable outcome of deregulation without the complementary consumer protections that would have made it genuinely competitive. If the Federal Reserve raises its benchmark rate to 5.25%, why doesn't your savings account rate follow? The answer is a concept called deposit beta. Deposit beta measures how much of a Federal Reserve rate change a bank actually passes through to its depositors. A deposit beta of 1.0 means complete pass-through. Every percentage point the Fed raises rates, your deposit rate rises by a full percentage point. A deposit beta of 0.3 means for every 1% the Fed raises rates, the bank raises your savings rate by 0.3%. During the 2022 to 2024 rate hiking cycle, the most aggressive Fed tightening cycle in 40 years, the deposit beta at major traditional retail banks averaged between 0.2 and 0.4. The Fed raised rates by 5.25 percentage points. The average traditional bank savings rate rose by approximately 0.45 percentage points, not 5.25 points, not 2.6 points, not even 1 point, 0.45 points. Banks offered two explanations. First, deposit rates. Lag rate changes because banks need time to assess the environment before committing to higher costs. Second, competitive market dynamics are sufficient to keep rates fair. Both arguments collapse under scrutiny. On the lag argument, during the same rate cycle, the same banks raised the APR on their credit card products in near real time, tracking the Federal Reserve rate closely. When the Fed raised rates, your credit card APR followed. When the Fed raised rates, your savings account rate barely moved. The lag only runs in one direction, upward for what you owe the bank, near absent for what the bank owes you. On the competition argument, behavioral economists and banking researchers have extensively documented deposit stickiness. Retail depositors rarely move their money, even when meaningfully better rates become available elsewhere. The switching friction is real, even when objectively low. Opening a new account, linking external institutions, waiting for verification, updating direct deposits. The actual time commitment is small, but the activation energy is high enough that the majority of depositors never complete the process. Banks are not unaware of this dynamic. It appears explicitly in their investor communications. The phrase sticky deposits is used as a compliment in banking earnings calls. Sticky deposits are the most profitable kind. The bank can pay the lowest rate for them while retaining them longest. Every feature designed to deepen your banking relationship also increases the friction cost of leaving. The integrated mobile app, the linked checking account, the bill pay setup, the branch relationships, the Zelle network. Making the relationship comprehensive and the switching process inconvenient are functions of the same design intent. Here is where the story becomes specific, because the rate disparity is not a case of banks withholding something that doesn't exist. The higher rates existed. They were available from the same institutions, in many cases, during the same periods. In 2023, while JP Morgan Chase offered 0.01% on its standard savings account, it offered 4.5% to 5% on certificates of deposit through its Chase CD products. Wells Fargo offered money market accounts and promotional CDs with rates in the 4% to 5% range, while its standard savings account sat at 0.01%. The higher rate products were real. They were FDIC insured. They were offered by the same institution. They simply were not the default. When you open a banking relationship with a major traditional institution, the products you encounter first, the products marketed to you, the products suggested during onboarding, the products featured in the app, are the checking account and the standard savings account. The products that earn the market rate require you to already know they exist, to navigate to them specifically, and in some cases, to meet minimum balance requirements that function as access barriers. A bank rate analysis from 2023 found that the 10 largest traditional retail banks in the United States offered standard savings account rates between 0.01% and 0.47%, while making certificates of deposit and high-yield money market accounts available at 4% to 5% to customers who sought them out. The information asymmetry is structural. The product that benefits the bank is the default. The product that benefits the depositor is available, but requires effort to find. Meanwhile, FDIC insured online institutions, Ally, Marcus by Goldman Sachs, SoFi, American Express National Bank, Discover Bank, were offering high-yield savings accounts with no minimum balance requirements, standard FDIC insurance, and standard withdrawal access at rates of 4.5% to 5.1% during the same period. The same federal insurance, the same liquidity, the same regulatory protections, a rate 400 to 500 times higher. The difference was not product quality. The difference was that online institutions do not have branch networks to fund. They compete on rate because rate is their primary differentiator. Traditional banks have branches, brand recognition, and deposit bases so large and so sticky that they do not need to compete on rate. So they don't. I want to be specific about this because the abstract numbers obscure what the rate gap actually costs real people over time. A woman named Simone works in healthcare administration in Atlanta. She's been at the same bank since she opened her first checking account in college, over 12 years. Last year, she had $22,000 in her savings account and earned $22 in interest. She thought that was just how savings accounts worked. When Simone looked up high-yield savings rates after a conversation with a coworker, she found an FDIC insured online account offering 4.6%. On $22,000, that would have been $1,012 in the same year. She had left $990 uncollected, not from a bad investment, not from a risky decision, from the assumption that the product she was handed at 22 was still the right product at 34. Simone opened a high-yield account and transferred her savings within a week. Her comment afterward: she wasn't angry at herself. She was frustrated that no one, not the bank, not a financial advisor, not a single personal finance resource she'd encountered in 12 years, had ever explained the gap to her in plain terms. A man named Derek had a different experience. Derek is an accountant. He knew about high-yield savings accounts. He'd been meaning to open one for 2 years. The reason he hadn't was the same reason most people give when they know the right thing and don't do it. It felt like a project. He had $40,000 sitting in a traditional bank savings account, earning 0.01%. He calculated the difference when the Fed rate hit 5% and discovered he had left more than $1,900 in the prior 12 months sitting uncollected. That number, $1,900 in a single year, was the activation energy he needed. He opened the account the same afternoon. The entire process took 38 minutes. Derek's situation illustrates something important about the deposit rate gap. It is not primarily a knowledge problem. Many people are aware that better rates exist. It is a friction and urgency problem. The banking industry benefits every single day that the $40,000 sits in the low-rate account, while Derek means to move it. There is no mechanism that notifies Derek that he left $1,900 uncollected. The bank does not send an alert when a better product is available elsewhere. The friction and the silence both serve the same interest. Let me put this in exact figures, because the abstraction does not carry the same weight as the actual math. You have $11,000 in a standard savings account at a major traditional bank. Your rate, 0.01%. Your annual interest, $1.10. After 12 months, you have $11,001.10. The same $11,000 in a high-yield savings account during the same period. Rate, 4.75%. Annual interest, $522.50. After 12 months, you have $11,522.50. The difference on $11,000, $521.40 in a single year. On accounts with identical federal insurance and identical withdrawal access. On $25,000, the annual difference is $1,185. On $50,000, $2,370. On $100,000, $4,740. These are not investment returns earned by accepting market risk. These are FDIC-insured accounts. The risk profile is identical across every institution. The difference is entirely a product of which institution holds the deposit and how much of the prevailing rate they choose to share. Extend that over a full rate cycle. From January 2022 through December 2024, the Federal Reserve rate averaged approximately 3.8%. A person with $30,000 in a standard traditional savings account over that period, earning approximately 0.2% average, collected roughly $180 in interest over 3 years. The same $30,000 in a high-yield account, averaging 3.6% over the same period, approximately $3,276. The difference? $3,096 over 3 years. On accounts with no difference in risk, $3,096 is not an abstraction. It is a month of take-home income for many workers. It is money that existed, that was earnable, that the Federal Reserve had explicitly made available in the system, and that never reached the person whose money generated it. This is not analysis specific to this channel. In May 2023, the Senate Banking Committee convened a hearing specifically to examine deposit rate transmission, why bank savings rates had not followed the Federal Reserve rate upward. Committee Chairman Sherrod Brown called executives from the major banks and asked the question directly. The executives responded with deposit beta arguments and references to competitive market dynamics. They cited the need for rate stability and the operational complexity of adjusting deposit pricing at scale. Senator Elizabeth Warren presented FDIC data showing that the spread between the federal funds rate and average bank savings rates had reached its widest level in 15 years. She described the dynamic as a wealth transfer from ordinary depositors to bank shareholders. That characterization was not rhetorical exaggeration. It was a description of what the FDIC data showed was happening mathematically. In the same period, the Consumer Financial Protection Bureau published research finding that large bank deposit rates are substantially less responsive to Fed rate increases than rates at credit unions and online banks, and that lower-income depositors, who are more likely to hold savings at large traditional institutions and less likely to be aware of high-yield alternatives, bear a disproportionate share of the cost of that rate gap. The people least likely to know about high-yield alternatives are the people with the least room to absorb the difference. The information asymmetry compounds the financial asymmetry. That is not a coincidence of circumstance. It is a predictable outcome of a system with no structural requirement to inform depositors of better alternatives. Here is the reframe that changes how you see this permanently. A standard savings account at a major retail bank is not a savings tool. It is a funding instrument. It is the mechanism by which you lend money to one of the most profitable industries in the American economy, at a rate the industry sets unilaterally, while the industry earns the actual market rate on the money you lent it and keeps the difference as profit. You are not a customer in that transaction in the way the word customer implies. You are a creditor who accepted terms without reading them, a funding source who did not negotiate. And the reason most people never recognize this arrangement for what it is comes down to product naming and product placement. The account is called a savings account. The marketing is built around security and stability. The features, the app, the linked checking, the branch down the street, are oriented around convenience and familiarity. The interest rate is listed in small type somewhere in the account agreement, beneath the sections about overdraft protection and wire transfer fees. The product is designed to be evaluated on everything except the rate, because if the rate were the primary evaluation criterion, the product would fail most comparisons immediately. Product design reflects intent, and the intent of the traditional savings account, from the perspective of the institution offering it, is to hold your deposits at the lowest rate you will accept without leaving. That rate has historically been very low, because the system has been engineered through switching friction, product placement, the absence of required disclosure, and 40 years of deregulation without corresponding consumer protections to ensure that most people don't leave. The savings account rate gap is one mechanism inside a larger system, and it is worth naming what sits beside it. The same banking system that pays 0.01% on your deposits charges 22.4% average APR on revolving credit card balances. The spread between what the bank charges borrowers and what it pays depositors is the financial engine of retail commercial banking. The same system that maintains suppressed deposit rates extracted approximately $12.2 billion in overdraft and insufficient funds fees in 2023, according to the CFPB. Overdraft fees fall disproportionately on lower-income account holders who maintain lower average balances. The same population least likely to hold high-yield savings accounts and most exposed to deposit rate suppression, low deposit rates, high borrowing rates, sticky depositors, recurring fee income from the most financially vulnerable customers. Each element is internally consistent with the others. Each reinforces the profitability of the whole. None of this requires individual bad actors at individual banks. It requires a system with aligned incentives where the most profitable outcomes are the most legally permitted ones, and where the depositor, the party with the least information and the lowest switching rate, absorbs the cost of that alignment. That is not a conspiracy. It is a documented, reported, Senate hearing level acknowledged transfer of wealth from the people who supply the banking system with its raw material to the people who own the institutions that process it. Two things change when you understand this fully. First, the account. High-yield savings accounts at FDIC-insured online institutions are not complicated or exotic products. They are standard savings accounts with standard federal insurance and standard access to your money. The application takes approximately 40 minutes. Many now offer next-day funding and automated transfer tools that have deliberately reduced the friction that traditional banks have every incentive to maintain. As of early 2026, even after Federal Reserve rate cuts from the 2023 peak, high-yield savings accounts at major online institutions continue to offer rates meaningfully above what traditional banks pay on standard products. The gap is smaller than it was at the 2023 peak, The direction has not changed. If you have money in a standard savings account at a traditional bank, earning less than 1%, the mechanism this video described is currently operating on your balance. The interest that should be yours is being captured as someone else's net interest income. Moving it costs 40 minutes and produces a measurable, compounding, risk-free improvement in what your money earns. Simone did it in a week. Derek did it in 38 minutes. The process is genuinely that simple. The obstacle was never the process. It was not knowing the gap existed. Second, the framework. Knowing how the savings account works changes how you evaluate every financial product you are offered. The question is no longer whether the app is good or the branch is convenient. The question is, what is this institution's incentive in offering me this product, and where does the money actually flow? Asked consistently across every banking relationship, every insurance product, every investment account. That question is the beginning of financial literacy used as a protective practice rather than just an accumulation strategy. You did not earn $52 on your $11,000 because you made a mistake. You earned $52 because you were never told that the product you were offered was specifically designed to pay you $52 and keep the rest. You were not uninformed. You were not informed. There is a difference between those two things. That difference is worth hundreds of billions of dollars a year to the American banking industry. Now you know where it comes from.